What the data is telling us, looking beyond the headlines, of course, this is a very much a headline risk environment we're in right now. Certainly the price of oil or the Iran war is really driving everything at this moment. I know the oil is up about 10% today so far, which is kind of crazy, and that's not the best news. But the S&P was down 2% a couple hours ago, and now it's flat. So I don't know what's up with that, but it's headline driven, right? It's something comes out in the news, a tweet, something comes out and moves things very, very rapidly. So we're going to explore some of that stuff today. I'm not going to show the oil chart because I didn't think when I was setting this up, I didn't have that wasn't as big of an issue as it is today. So I'm really curious to see how that goes going forward. And if it stays high for long, that could be an issue. But that's not what I'm going to talk about today. So today we're going to talk about seasonality. I'll talk about how nothing good happens below the 200-day moving average. I'll look at the current monthly flow stats as always, just to get an update so you can see where the market is, where money flow is going, and then growth versus value. I feel like I've been beaten on this quite a bit, but knowing what's stronger and how it's helped us navigate this market pretty well, I'm going to show you a couple examples of that at the end to show you how we are doing. So let's start off with the seasonality. So based on midterm election years, typically we start straight down, and then February, March into April is usually pretty positive. That's not really how it went. It really kind of was like nothing, and then fell off into March, right? So February was March was pretty bad. April is so far positive, interestingly. So we'll see how that goes. But historically, on the second year of an election cycle, we get rough time into July. I don't know if that's going to play out. We're not really following that playbook so far this year, but I think it's just, I always want to keep it in my mind so I know what could happen or what has historically happened in a similar scenario. All right, but if we look at the past 10-year average, interestingly, this is a little more normal, right? The market didn't really go up here, but it did go sideways. It wasn't a big move up. I mean, this is only a couple percent. But then really from February to March, yeah, we had a sell-off just like that, which is more common of the past 10 years. So that's interesting to note. And then from there, the expectation is really more of a sideways chop until summer. Maybe we get a spike in June. Maybe we get a run up in July, maybe. But, hard to say. Or maybe we get a good run from here. But it's looking more like the average of the last 10 years than it is the presidential cycle so far. But I want to make that note of that and just kind of keep aware of that. Another interesting one that I'm not showing is if you take just the years that Trump has been elected, that's an interesting chart too. It's a completely different layout, which is interesting. So I may bring that up next time if it keeps following that pattern, which that may be the closest of all. So let's look at nothing happens below the 200-day moving average. Supposedly is quoted by Paul Tudor Jones quite some time ago, but in context, you have to think the market below this number. So I'll show you here. This is the 200-day moving average in the red line. This is the S&P over the past 3 years, I believe. When it goes below there, back here in 23, we dip below and then went right back up. V-shape, great. Not really worried about it. Here, the 2025, this was the tariff tantrum. Actually, that was in here, but we went down into it below. We came up, and actually, we'd call this a failure, right? It came up here, tried to peak above, and then nope, that's a problem. We're in a situation where we could do either of these scenarios right now. So we could we went below or we came back up, and now we're just kind of unsure. I want to see us break above that if we can pretty soon in the next couple of weeks. That would be a positive for the market. If we start to break down lower, then I would guess that we're more likely in this kind of scenario, and something's got to shake out first before we get the big run up. And that's interesting. And this also somewhat illustrates a common thing that said that if you miss out on the top 10 days of the market, you're missing out. And that's really kind of a dumb statement, because here's probably some of the best up days in the market right here. But if you missed all of them, you're probably better off. So the best days happen usually next to the worst days, and that's kind of what happens below the 200-day moving average. Really kind of fun is Michael Gaia did a paper a few years ago on how much volatility happens above and below each moving average. And we've got here the 10, the 20, the 50-day, the 100-day, and the 200-day. This is what we're talking about here, is how much volatility happens in the market up and down above and below that line. So above it, it's all pretty mild, right? Pretty consistent, 14, 15-ish, somewhere in that range. But then below these moving averages, it just gets higher and higher. Below the 200, I mean, we're looking at almost 2 times volatility, 2 times the ups and downs. So really, when the market is below that number for a sustained period of time, it's probably not a great time to be invested. It's certainly something to keep in mind, and that's a factor we're keeping in mind. And a lot of trend following strategies uses that as a filter to understand which kind of market we're in. So we are definitely below that, but we're now making that time where do we blast through it and go up and we're fine, or do we bounce off it and fall lower? Right now, it's hard to say which way it's going to go. I'm leaning that it's not going to be that bad, but the price of oil, as I mentioned earlier, could actually make it worse in the longer term if that stays higher longer. If that can retreat pretty quick, I may not be too big of a deal. All right, going into our money flow. Yeah, of course, it's been below the moving average for here. We've had a couple nice little spikes up, but really nothing great. I know today is actually back above this red line last I saw. So it's coming back, but this is not positive. I think last webinar we were right here. We were the first day below, and really at that time it was more expected that we'd see just like a dip below and the bounce back up. Right, money had been coming in pretty quickly back into the market, but this moving average is flattening and kind of rolling over. We need to see money come into this market very quickly to see that recovery happen. As I always say, that's kind of how we know the market has money behind it that's going to push it higher. And we're having some good spikes, but not enough yet to really push us back above that 200-day moving average, which is going to be key in the next few weeks. All right, our money flow cycle, this is actually positive today as well. But what's interesting is going back even to mid-March, the market did kind of have some choppiness, have a couple good days, and then it fell apart. Some good days and it fell apart. And the downs were actually worse than the ups, but the money flow was going up. And that was really interesting because every time we're getting sell-offs, it's short-lived or there's not a lot of money behind it, but enough to just scare people. And that's sometimes what the market tries to do, tries to get people to sell out of their positions, be scared to, hey, I need to be out of this market. And then it rips higher. That's common. So I was kind of thinking that from the look of this, that's what was likely going to play out. And in Monday, Tuesday this week, we had some great runs that were very strong. But then yesterday was crazy, and today's just a roller coaster. So hard to say where that's going to go. But yeah, so far money flow's good. This is back above the neutral line, so that's not a bad sign in the short term where this could go. Maybe we run up for another week before testing, but we'll have to see. So of course, the market indexes right now, the strongest one is Latin America of all places. They're more of an energy-based economy, so that makes a lot of sense because energy has been doing really well, and I'll show you that in a minute. But top of the thing is Japan, internationals again, but really all of them are kind of turning positive. We've got this grouping here, S&P and NASDAQ, not so much, but everybody's above their 8-day, so that's like an early sign that something could be good. MACDs are starting to turn positive. I think these are even positive today, so that's good. So we've got a lot of things building below. We have to see them follow through, and that's really what's key. Next, as I said, energy over here has been the positive one. It had an ugly couple of days. Maybe that is done because now we're seeing all the other sectors playing catch up, and the top ones over there that look promising: basic materials, utilities, financials, industrials. That's where the strength seems to be at the moment. And I know Chad and I were talking about basic materials and a couple of these yesterday. This is what could lead the market higher, or at least these could go higher while the market's figuring itself out. Interesting scenario there. And then, of course, energy. This is a great visual, I think, of how everything's played out. Energy's been this lone wolf stock sector that's just been way great and way up in the leading, super positive, while everything else has been looking ugly and falling apart. But the last few days, not so much. It's showing the weakness. I think today it was up last I saw, but what I like about this over here, and I talk about this a lot. If you follow me on Twitter, I do show this weekly. I love seeing the bulk of the S&P sectors grouped in this red box, because what happens next is a move up, almost always. It could pop up and fail, but typically when they're all grouped, it's meant for a big push upwards. Right now, financials and XLB, which is basic materials, are leading the way, and we've got several that are just about to pop through there. What I'd love to see is these to all pop up here and follow through into leading, and that would support a positive market run, at least for the next few weeks. And that could push us back above that 200-day moving average again. Another potential positive setup right there. Again, it doesn't always happen, but I do love these setups. It's usually a pretty strong, I think of a spring that's coiled, that's ready to release some energy, and that's set up to release it to the upside. And I think that's likely where that's going to go. Again, looking at the new lows, even through this crazy month, I mean, we're not getting that many. 200 is a good number, but I kind of think of 150 as the line in the sand. We're like, okay, something might be up, but it's only spending a day or two down there and then reverting very quickly. So there's not that much fear, not a lot of stocks going down. Again, when you go back to the tariff tantrum, this got to 1,000, right? 1,000 stocks were hitting new lows. A couple hundred is not that bad of, 3, 4,000, 5,000. That's a small percentage, but it's noteworthy. But we're back up here, so there's not a lot of fear yet. That's another hint that this may not be as bad as it might feel out there right now. And then the last couple of slides here are about the value versus growth. I think this has been very, very key. This has been very key for us and how we've held up very well in this environment without fully getting out and going into cash just yet. If the S&P fails that 200-day, then we're going to definitely get more defensive and into cash and the money markets and protection. But as this shows, when the ratio of growth to value, this is rising when growth is good, falling when value is good, right? The strength is in the value side. It's not good for the stock market. Now, it took a while for the market to catch up and really understand what was going on. But typically, when you have this going down here, that's not great for the market. And it doesn't necessarily mean down, but it usually means sideways and struggling. So it could be a little bit messy as that's happening. So we did actually shift into value back around here. And I'll show you that on the next slide on how that's really held up. So the green line is a value ETF that we use quite a bit of. Red is a growth, and the S&P is in this purple. Back here in November, December, we were shifting from the red to the green, and it's really held up. If you kind of see where the year started right there, we're right there. It's just it was good, and then it gave back a little bit, and it never means we're gonna miss on pullbacks, but we're really not participating that much. Whereas growth, they're way below. They got hit way, way harder. But if that shifts, then growth leads the economy upward. So I want to see growth retake that lead. But for now, us hanging out in value has actually held out very well. We're very, very resilient in this market.